Getting more voices in on this Thursday afternoon. I mean, the kind of up move and the volumes with which it has come is truly astounding, and it's clearly the banks leading the charge. In fact, that's the first question I'm asking Abhay Agarwal this afternoon, Managing Director of Piper Serica Advisors, who's joining in. Abhay, great to speak with you. You know, the faith that we're seeing in banks ahead of key results this weekend, what is that telling you? Because yes, we have seen interest rates dipping. They're going to continue to dip. But the transmission cycle is not necessarily giving us a great story for banks. Why do you think banks are leading the charge?
Yeah, I think, thank you first of all for having me. In our model portfolio rebalance that we did in this quarter, we have added 4 banks, and that is after not having any banks in the portfolio for almost 18 months. We track the sector very carefully, and I'm not surprised by this up move, and it is a lot to do with a reversal in a lot of things that put banks under pressure. The primary one being the restrictions that were imposed on lending to unsecured segment starting from January last year by RBI. And I think that sucked away a lot of liquidity. And if you look at MFIN data, the unsecured lending as a pool by banks fell from 4,50,000 crores to 3,70,000 crores. So there was a lot of pressure that banks took in terms of asset quality because of very strict NPA recognition norms. Provisioning was high, especially in the December quarter, because a lot of people who could not pay on time were tagged as defaulters and provided for when they were not really defaulters. So I think a lot of those things are reversing very quickly. The new RBI governor that we have clearly has given a very strong signal to the market that they will be supportive of liquidity and a lower cost of capital and focus on growth. So I think I'm not surprised that investors are looking at, especially the smaller banks that are trading at book value or some below book value, to make their bets now.
An interesting point that you made is where investors are actually watching out for the smaller banks. How are you looking at the kind of volumes you're seeing today? I mean, in terms of HDFC and ICICI Bank, because in terms of opening trade today, volumes have been super strong. Saturday is when both these banks will declare their results as well. How sustainable is that going to be? Because again, to some extent, the anticipation is that there could be profit booking in the last hour of trade with both these banks as well, just before the earnings. How would you look at this large cap banking space then?
No, I think large cap banking space, we are very positive. I think a very strong technical and fundamental bottom was made in large cap banks in the last quarter. We are seeing the technical and fundamental both becoming favorable for large banks. The volume-based buying that we are seeing, I don't think is going to stop beyond the results. I'm expecting the commentary from the banks to be positive after a long time. I think last 2-3 quarters we saw the commentary being cautious, which was rightly so, but I'm expecting that the banks will signal that the worst is probably behind, and then we are getting into a cycle which has lower cost of capital, better credit offtake, and better margins. So I think that's what the markets are also anticipating, and I don't really see these stocks correcting. Of course, there will be profit booking, that's part of the course, but I expect the trend to be upwards over the next 12 months.
Mr. Agarwal, it's Puneet here joining in as well. Thanks so much for joining in. You mentioned that you added 4 new banks in your model portfolio. Any names that you can suggest? Is it only private banks, or have you added any public sector banks as well?
We are still adding them, so the names are not yet public, but these are, our focus is more on stocks there where we can benefit from a multiple expansion also. So these are all private small finance banks.
That's interesting. That's interesting because your microfinance or your asset quality question, which has been plaguing the space, seems to have receded. So a couple of factors, Abhay. I'm just trying to, let's zoom out a little and look at the big picture. CapEx rollout expected to pick up. consumption expected to pick up now that the tax incentives announced in the budget are going to start kicking in, and maybe a distinct advantage for India versus China, for example. If I were to, off the top of my head, think of 2-3 reasons for this rally, would this make your list?
You're talking about the banks per se, or
No,
generally?
overall, reasons for this rally.
No, I think, as I said, and I've been saying this also, that the correction that we saw in India especially was very sharp, very vicious in the last quarter, starting January, February, and part of March also, because of various fears, domestic slowdown, FPI selling, and a lot of those reasons have reversed also as quickly. You have seen the US dollar correcting, the US assets becoming less attractive. So we are seeing, more conversations from foreign investors coming into India after a long time. Fundamentally, things are improving, better, lower taxes, lower interest rates, domestic consumption coming back. So I think every which way I look at it, I'm pretty confident that there are very solid technical and fundamental reasons for this rally to sustain.
Right. Abhay, we've spoken about the financial space. You have private banks, which is the top gaining sector today. But apart from that, let's look at 2 other sectors which have exposure to the export market to a large extent, auto and pharma, both of them seeing a recovery in trade today. Now, there is constant back and forth with regards to tariffs. How would you advise investors to now look at the auto and pharma space, taking into consideration the recovery that's probably coming in?
I would say on the auto, especially the four-wheelers, it's still a domestic story. And the good thing is that the stocks went through a sharp correction. Whatever channel checks we have done recently, there seems to be more inquiries. Some inquiries are also converting into sales. Price cuts that were taken in March and January helped a lot. So I think overall the demand environment for four-wheeler consumer vehicles, passenger vehicles is positive. On the export side, I think it's more of a two-wheeler story, and that also seems to be holding up pretty well. So I think autos is a segment that we haven't added yet to the portfolio, but we are looking at it actively to see what are the plays there. But on pharma, we are far more constructive. I think for the last 18 months has been an overweight for us, and we plan to keep it that way. I think the Indian large cap generic companies have done a lot of good work over the last 5 years, and they are in an environment where their hard work is getting rewarded in terms of the large product pipeline they have, especially for the US launches. The US FDA is very friendly to the Indian companies right now, and I expect that to continue to be the case. So I think for the pharma companies, it's a great environment to benefit from.
What would be some of the pharma companies you're really liking now, Abhay, to whatever extent you're, giving us direction on it?
In our model portfolio, we have 2, which is Dr. Reddy's and Divi's. Divi's more so from the CDMO perspective. But at this point of time, I would say that if you look at last calendar year, pharma index was the best performing sectoral index in Nifty, and I'm expecting that to be largely the case this year also. I think people will be surprised by the commentary and the results that they see from pharma companies. So I would say that you can pretty much pick up any of these large caps and bet on them right now.
Interesting. So we'll take that point away from what Abhay is saying, that pharma is going to surprise on the upside perhaps this quarter as well. Thank you so much, Abhay. Always a pleasure speaking with you.